Have you ever looked at the stock market and thought, yeah, that's just rich people pressing buttons and yelling into headsets? Good news, that's not how it works anymore. You don't need a floor-length trading jacket or 5 computer monitors to get started. Bad news, you still can't just wing it and hope for the best. The stock market is often painted as this scary, complicated world full of charts, jargon, and people who somehow turn coffee into money. But in reality, it's just a marketplace. And like any marketplace, there are different ways to shop and different ways to profit. Some strategies take minutes, others take decades, and some will make you question all your life choices at 9:31 a.m. on a Monday morning when the opening bell rings. Today, I'm breaking down 7 proven ways people actually make money in the stock market. We'll look at the pros, the cons, and most importantly, which one actually fits your personality. Let's get into it. 1. Day trading, the espresso of investing. Day trading is the most intense, high-octane way to earn money in the market. It means buying and selling stocks within the same day, sometimes within seconds. How it works? A day trader isn't looking for the next Apple. They are looking for volatility. They want a stock that is moving right now. They use technical analysis, those squiggly lines on charts, to predict where a price will go in the next 10 minutes. If they buy at 10 and sell at 10:05 5 minutes later with enough shares, they've made a day's wage. Pros, potential for quick daily gains. You don't have overnight risk, where bad news happens while you're sleeping. Cons, it is a full-time job. It's high stress, and because you're trading so much, fees and taxes can eat your profits alive. Best for people who thrive on adrenaline, have a math-heavy brain, and don't mind staring at a screen for 6 hours straight. 2. Swing trading, day trading's chill cousin. If day trading is a sprint, swing trading is a 400-meter dash. You're looking to catch a swing in the price that lasts anywhere from a few days to a few weeks. How it works? Instead of watching every tick of the clock, you're looking at patterns. Maybe a company's stock always drops before earnings and bounces back after. You buy the dip and wait a week for the bounce. Pros, you don't have to quit your day job. You can check your trades on your lunch break. Cons, you are exposed to overnight risk. If a company releases bad news at 8 p.m. on a Tuesday, your stock might gap down before you can sell it Wednesday morning. Best for people who want higher returns than long-term investing, but also actually enjoy having a life outside of stock charts. 3. Futures and options, advanced mode activated. This is where investing gets spicy. Futures and options are derivatives, meaning you aren't necessarily buying the stock itself, you're trading a contract about the stock. How it works? Options. You pay a small fee for the right to buy a stock at a specific price later. If the stock moons, you make a massive percentage gain. If it doesn't move, your option expires worthless, meaning you lose 100% of what you put in. Futures, these are obligations to buy or sell an asset like oil or gold at a future date. Pros, you can make money when the market goes up, down, or sideways. You can also use them as insurance for your other stocks. Cons, extremely complex. You can lose money faster than you can type what is a call option. Best for experienced traders who have done their homework and understand that leverage is a double-edged sword. 4. Dividend investing, getting paid to be patient. Dividend investing is the boring strategy, and in the world of money, boring is often beautiful. How it works? Some established companies, think Coca-Cola or McDonald's, don't need to spend every cent of their profit on growth. Instead, they give a portion of that profit back to you, the shareholder, in cash. This is called a dividend. Pros, it's the ultimate passive income. You get a check every quarter just for holding the stock. If you reinvest those dividends, your wealth grows exponentially over time. Cons, dividend stocks usually don't moon. You won't see 500% gains in a week here. Also, if a company hits hard times, they can cut the dividend. Best for people who want to build a money machine that eventually pays for their lifestyle or retirement. 5. Long-term investing, the wealth builder. This is the buy and hold strategy. This is how the quiet millionaires next door are made. How it works? You pick high-quality companies or blue-chip stocks and you hold them for 5, 10, or 20 years. You ignore the daily news, the political drama, and the market crashes. You believe that over time, great companies provide great value. Pros, historically the most reliable way to build wealth. It's low maintenance and has the lowest tax burden. Cons, it requires the discipline of a monk. Watching your portfolio drop 20% in a market crash and not selling is the hardest thing you'll ever do. Best for literally everyone. This should be the foundation of almost every portfolio. 6. IPO investing, the hype train. IPO stands for initial public offering. It's when a private company, like a hot new tech startup, lists on the stock market for the first time. How it works? You try to get in early on a company you think will be the next Amazon or Tesla. Everyone is talking about it, the news is covering it, and there's a lot of FOMO, fear of missing out. Pros, if you catch a winner early, the gains can be life-changing. Cons, it's incredibly volatile. Often, the big players sell their shares as soon as the public buys in, causing the price to crash. It's more like gambling than investing if you haven't read the company's financial filings. Best for investors who have play money they are willing to lose and who enjoy deep diving into company prospectuses. 7. Index funds and ETFs, the easy button. If you don't want to pick individual stocks because you're afraid of picking a loser, this is for you. How it works? An exchange-traded fund ETF is like a basket. Instead of buying one apple, you buy the whole orchard. An S&P 500 ETF, for example, gives you a tiny piece of the 500 biggest companies in the US. Pros,
Instant diversification. If one company in the basket goes bankrupt, you barely feel it because you own 499 others. It's cost-effective and proven to beat most professional investors over the long run. Cons, you will never beat the market because you are the market. You'll never find the next 100x stock here. Best 4, the set it and forget it investor who wants to grow wealth without the stress of picking individual winners. There's no one-size-fits-all way to make money in the stock market. Your best strategy depends on 3 things. 1, your financial goals. 2, your risk tolerance. Can you sleep if your account is red? 3, your time. Do you have 5 minutes a week or 5 hours a day? If you're just starting out, my advice is to start with the boring stuff, ETFs and long-term investing, while you learn the ropes. Consistency beats complexity every single time. Which of these 7 strategies sounds most like you? Are you a day trading adrenaline junkie or a dividend passive income seeker? Let me know in the comments. Don't forget to hit the like button if this helped clarify the market for you, and subscribe for more deep dives into building wealth. Thanks for watching, and I'll see you in the next one.